James and Alan, I will get to your questions in just a moment. We did have some questions that came in via email. And both questions actually were from David. And David wanted to know, how reliable are the percent probability below or percent probability above numbers that are on power options that you can use on the screening tool for different strategies, search for positions that have a high probability of expiring worthless or a lower probability depending on your strategy. And here's the idea. The probability is based on where the stock has been. It does take a look at volatility. It takes a look at the current stock price, the strike price. A lot of the criteria that are used in probability are also used in the Greeks for delta and things of that nature. But it's looking at where the stock has been and the level of fluctuation in the past, volatility, and how likely is it to be trading at or above or at or below a strike price at the expiration, whether you're looking 14 days out, 30 days out, 80 days out. Now, this assumes that market conditions remain generally the same as they have been over the time frame that the calculation is using. There's no sudden negative events such as a black swan, outside geopolitical events, changes in the sector valuation, or outside valuation as well. The numbers are pretty reliable. Other things that will throw the probabilities, or even your deltas if you use those when entering an out-of-the-money spread trade or more, upcoming earnings. Not a good idea to bank on probability in a spread trade if you've got earnings coming up 5 days before your expiration date. Stock could swing any direction. You don't know. Any stock with an FDA approval coming out, phase 2 or phase 3 trial, outcomes of a pending lawsuit, change in a board of directors, that can all throw the probability into turmoil. Okay? You should avoid trading certain strategies if you know those events are coming up. Well, how does it work in practice? Well, as I mentioned, it all depends on the market conditions being the same. Now let's take a look at the top 15, the weekly picks of the day, naked puts, if I'd opened them on Monday, June 25th. Normally following the weekly picks of the day for covered calls and naked puts we show on power options. We just take the top 2 or the top 3. Now all positions have a 75% probability or higher when the search was run on Monday the 25th. So here we see that we have our probability above. When I sell a naked put, so for example with Whiting Petroleum at 53.16, I'm selling a 1 week out, slightly out of the money put in this case, 51 strike, even though the stock was down 230 at Monday. But we're going out of the money looking for a reasonable premium, reasonable yield, of course, and we want that good probability that the stock will stay above the strike price. Here's our strike price in the circle. This would be the stock price. We want the stock to stay above that so the put expires worthless. We keep the premium. All of our probabilities are in the 79, 78, 80 percentile range or more. Okay, so that was on Monday. Now going forward to today, we can see here that pretty much all of those positions match their goals. WTE, remember, we sold the, WLL, we sold the 52 strike, or 51 strike, and the stock ended at 52.95. This was about an hour before the close, so I want to get the slides together. But over here on the far right, you can see pretty much all of them had a positive return, or at least hit close to the maximum return, with only 2 differences. And what is the big one? The big one here is Dave & Buster's dropping down to 47.98, so it's a loss of 175. Okay, so something happened there, but 13 out of the 15 were profitable, 87%. Average return was around 0.3. Could have been taken into account because this extra 3% loss, but you saw some of the returns, 0.5, 0.6% yield for an out-of-the-money put for 4 days is pretty good. Okay, it's a pretty decent range. But we see an 87% level of success, and the average from the last slide, with all the probabilities accounted for, was probably in that 82% range, so we're right on par. All right, now, what happened with Dave & Buster's, PLAY? Well, although it came up on the search, and I circled the graph for June 25th, Monday, when we ran this search. Well, I used the historical tools today to run the search, but this would have come up. I likely would have not entered that trade. Now, yes, it matched the criteria where the stock has been above the 20-day moving average. It's been in an uptrend. It's not bouncing off the bottom of the Bollinger Bands, and it did have a MACD where the MACD line was above the signal line for at least 4 days, but it was just starting to cross on Monday. And this pop here was just after earnings from June 11th. And you see a continual decline. So I probably wouldn't have opened this trade. I probably wouldn't have opened 15 naked puts as I mentioned. I would have opened the top 1 or 2. Okay? But in any case, when I see this kind of signal, on Monday, I would not have opened this trade. It just continued down and continued down. We end up below $50 per share. Stock was around $47.98, so it was a 3% loss. Now, going back and looking at it, of course, when I looked at the headlines, the earnings that came out for PLAY, Dave & Buster's was up over 16% on June 11th for better than expected first quarter results. But same restaurant sales and entertainment sales were still declining from the last quarter and over the year. That's a negative. And the rest of the end, goes on to say this is in spite of overall restaurant industry recovery and so forth. So this wasn't a good trade, and the chart itself would have turned me off of it. But the probability of the past movement, it still had a 75% probability or higher of staying above the put strike price. But with due diligence, had I checked the stock chart, the news, look at the earnings and events, any upcoming events that are listed, taking a look at the recent headlines, maybe dividends, I would not have entered PLAY because of the chart and because of the news and the write-up after the earnings on June 11th and seeing what happened after June 11th. It was more in a bearish trend, even though it still had a positive MACD, even though it still was above the 20-day moving average. It was falling down, pulling away from the upper Bollinger Band. It matched the criteria, but it wasn't a good trade. Now, that's a snapshot view, I know, but we wanted to show you that there wasn't much that happened this week that caused market fluctuations, which we've seen in other weeks, where suddenly on a Tuesday, we're down a significant amount. We did see on Monday that there was a significant drop, but during the rest of the week, those top 15, we still had an 87% success rate, looking at a probability about 82%. That just gives you sort of a view of how you can use the search tool, but what to expect with the probabilities. Now, the follow-up question, and I have 3 questions now, and I'm going to get to all your questions you just sent in from John, from James, I mentioned, and from Alan, but we're just going to cover something real quick. David went on to say that his main option strategy that's currently running is Bear Put Debit spreads. Selling in the money put, buy a higher strike put for a debit. If the stock stays below both puts, you close out the debit for the difference in strikes and take your profit. He says, anything that you have to say about them would be of interest to me. Okay. Well, the main key to remember is that debit spreads are a parity trade to the credit spreads. Both offer good leveraged returns, good leveraged strategies. They do run the risk of the lie of leverage, which can get investors into trouble, but a debit spread requires an extra commission to close out the trade. I have to actively close the spread or have my broker close the spread, both legs, to get the difference in strike prices back if it worked out as I expected. Whereas in the credit spread, if it does what you want, the 2 options just expire worthless and you keep the net credit. In a debit spread, you're starting off typically in the money. They may be done in an alternative fashion. We'll talk about that in a moment. But because you're doing spreads that are in the money and selling a put and buying a put that are both in the money, you do run the risk of early assignment. You don't control that. The parity trade, the bear call credit spread to the bear put debit, is out of the money. You don't have to worry about early assignment unless the stock goes the wrong direction and goes above your short call strike price. All right, but let's go ahead now and navigate over to the Power Options suite of tools. Let's quickly take a look at an example of a debit spread and a credit spread, what would happen at expiration and the alternative. Now, one thing I'm going to do here is I'm going to go to Bull Put Credit here, but I'm going to go to a tool that we use called the spread chain, okay? And it's a simple view. And we're just going to look at SPY for, let's say, 2 weeks out. Okay, so July 13th for SPY. And I'm going to look at the call credit and put debit parity view, bear call credit and bear put debit parity view. We're just going to use a 2-point spread. I'd want a net credit of at least maybe 15 cents. Return of 7 is fine. I'm going to put a probability of 80 to 90. This is just to limit the number of results. Okay, so let's go ahead and submit that and see what we get. Okay, good. Now, on the left are our bear call credit spreads. SPY, oh, let me get this different color pen, folks. I'm sorry, there we go. SPY is currently trading at 271.34. I might enter a bear call spread by selling the out of the money above the stock price 277 call and buying the 279. Okay. Sorry, there you go. My apologies there, the screen did not unlock for us. Okay. All right, and nope. That's better. Okay. Sorry about that. So here we are. We're in the spread chain tool. We put in our criteria for the strike difference, net credit, return, and probability range. And again, SPY is at 271. If I was bearish, I could sell a 277 strike call that's out of the money by about $5.64 and buy the 279. I would get a credit of 28 cents. Now, my broker would require that I put up the margin of 2 points in case the stock went up above 279, the ETF went above 279. There's an 80% probability we'll be below 277. Both would expire worthless and would receive the net credit. We just keep that into our account. Now, with the stock trading at 271-ish, the parity trade is the debit spread. So I could sell the 277 put, which is in the money, and buy the 279. And at midpoint, I'd pay $1.77. So what happens if the stock stays above 277? Well, I have an obligation to buy shares of stock at 277 with my in-the-money put, which can be assigned at any time. Okay, it could be assigned early because it's already in the money. Right? And the 279 put gives me the right to force someone to buy it. So if I go through expiration in 2 weeks and the stock is still below 277, if I do nothing, I'll be exercised and forced to buy shares of stock at 277. My broker will immediately sell them at 279 in the Bear Put Debit Spread. I get $2 back, so we have a profit of 23 cents on an investment of 177, or 13%. Probability is the same, right? Same being below that same strike. So what's the difference? To close out the debit properly, I'd need those 2 commissions. I pay the commissions to enter the trade, and I'd have to pay the commissions to close it manually or do it the other way as well, okay? And at the same time, hold on one second there, folks. At the same time, with the credit spread, if the stock stays below 277, then we just keep the credit and we don't have the extra commission. But remember, the call side is out of the money. So until the stock goes above 277, we can't be assigned early on the short call and the bearish call credit spread. We're starting the Bear Put Debit already with both in the money. Now, early assignment is not a bad thing in most cases. Remember, we sold that 277 strike put. So if we're assigned early, many brokers, and hopefully yours, will simply exercise this long to deliver the short, and you get your 2 points back that you were expecting. Not a problem. However, some brokers don't automatically do that. That might be an issue. If I did 10 contracts and I got assigned early at 277 and I didn't know about it, well, technically all my broker can do is buy 1,000 shares of SPY at 277 because that was the price. So I've got to buy those shares. Now, at open or later on in the day, I get the notification. I can't exercise the 279 to get out of the position. That's fine. But it may result in a margin call. It may result in some weird financing. We don't know. But that's one of the concerns when you're looking at a debit versus a credit, is to remember that in the debit, you're starting off typically in the money. If you want that probability of expiring worthless, you don't control if you get assigned early at that short strike. Okay. Now, I had mentioned another way to do a debit spread. Let's go to the custom spread tool. What some investors might do if they're more bearish on a position, and I'm not saying you should be bearish on SPY. This is not a suggestion. But rather going 1 week out to mimic the return of a credit spread, what an investor might do if they're more bearish on a position is do an out-of-the-money bear put debit in this case. If I was bullish, do an out-of-the-money bull call debit. Meaning with SPY at 277, I might go out 30, 40 days out in time. Let's go to July 30th, near the quarterly, or I'm sorry, near the end of month. We'll go July 30th. Remember, a bear put debit, we were looking at selling the 277 put down here and buying the 279. What if I sold the 270 and bought the 272? What does this do for us? Well, it's still a bear put debit spread. And we're just going to do one contract to keep the math simple. It's still a bear put debit spread, but it's out of the money. It's a low cost because you're closer to the stock price, so these premiums are more equal. Whereas when you go deeper in the money, you're closer to intrinsic value. As we saw, we paid $177 for a two-strike away spread. But if the stock does fall as you expect in 30 days down below 270, your max profit is $132. You still get that 2 points back, but you only paid 68 in instead of $1.77. This is a longer term play. It is more speculative. It does have a known and low risk. The risk is if the stock goes up to 273, 274, both of your puts here expire worthless in the bear put debit, and you lose the 68 cents. And of course here the break even is right about where we are right now because we set it up to be sort of even, 1-to-1 or better risk reward ratio. But it is more speculative because now you need the stock to fall. You need it to move down below there to get the maximum profit. This probably only has a 33 to 38% probability of SPY trading below, maybe 40%, but it has a lower probability of reaching the full success, not reaching a profit, which happens anywhere in here. But reaching the full profit, that's the trade-off. The probability is lowered as opposed to where we had an 80% probability of doing the 277, 279 spread. Some investors will do this in bullish nature. The opposite, a bull call debit spread, where if I was bullish, I might sell a 275 call out in August or further out and buy a 265, a 10-point spread. But my debit might only be $5 or $6. So I'm close to a 1-to-1 risk-reward ratio, but again, I'm only going to have a 40 or 45% probability that the stock would be above 275 in the next 30 days. It's the trade-off. Okay? That's the trade-off on the position. So there's nothing wrong with debit spreads, but remember you take on the extra commission. You're selling in the money usually to start with to mimic the credit spread profit and loss chart, so you run the risk of early assignment in that scenario. Okay? And, sorry, I was reading Fernando's comment. He says, I use the spread front chain sometimes to protect an unmarried put when his expectation is short. Okay, but where I was going with that is that under the bull put credit or any of the vertical spreads or the signature tools, when you go to spread chain, you can take a look directly at the bear parity, so you can compare side by side the returns, probabilities of doing the bear call credit or the bear put debit to see which one best suits your needs, which one gives you the best return when you know you have the same probability and more. All right, so that's the tool to use to compare it. If you decided to open a credit spread, compare it to the debit spread and go from there. All right, now to the questions that have come in since the webinar began. Start with Alan. Alan sold a July 20th 350 put for Boeing, BA. Stock is now at approximately 335. What are my options to minimize losses on this trade? Okay, first, let's take a look. Yeah, look, let's go to the portfolio. And I don't want to do that one. I'm going to do, one second here. Here we go. Let's just create the Boeing position. I don't know the premium you got for it. It's okay, Alan. It's irrelevant. So let's go ahead and enter in our short put for BA. And we're into July 20th, 1 month away, 21 days. You sold the 350 put. Let's just do one contract again to keep the math simple. Doesn't matter when you entered it, but we'll just change the date. Let's say you got $450 for it. Maybe you didn't get that much. It's okay, Alan. All right, so When I'm tracking a position in the portfolio, the first thing I'm going to do, of course, is check the position analysis. Here's my position with Boeing. We know we're down $1,240 based on whatever premium you received. I put in $450. All right, so as I'm tracking the portfolio, go to Position Actions and then Position Analysis. This gives you a breakdown of your current position, where we stand right now. If I got that $450 premium, I'm down 3.6% or $1,260. I'll lose about the same 2.9% when all the time value decays. All right, so it shows us some potential rollouts, but it doesn't look like anything is getting us back to a positive break even. I'm sorry, Boeing is at 335.51. So I'd have to roll down pretty low. And if I go out to August, I can get 13.25. So if it flattens out here and moves back up, yeah, it's going to cost me a lot to buy back this put. We'll get another 65 cents there. So we get an adjusted net credit. I'm sorry. Your buyback costs you receive 13.25. You could get a 1.7% return on the position. And it shows you some going further out as well. September's not quite where we want. Okay, depending on your outlook. So those are some ideas, and you can always see the side-by-side comparisons here. If I use the Simulate Trade feature, here's my original position in red. That's the profit you were looking for. We'd lower it to a smaller profit here in this case in the Simulate Trade. Once you have to be tracking a position in the portfolio to see the analysis in the Simulate Trade. You can't just go to this tool by itself and put in numbers, but just enter the position in the portfolio, evaluate the rollouts in here. This is one option that gives you the potential for a very small return of 65 cents if the stock stays above 335. If you think it's bottom now and is moving back up, that is an option. Okay? But there are other things that you can do because of the prices and where you are now. Let's just go to the profit and loss rate. You're expecting a 1.3% return. Now that was based on my premium. Okay? So, what are some of the options? Well, let's go through them real quick. Number one, close and take the loss. Look to make back the loss with other naked puts that match your trading plan. It might take you a couple of trades, maybe even a couple of months. Two, if you're bullish long-term on the stock, you think it's going to recover over time, maybe let it get assigned if you wanted to own the stock. Own shares of Boeing. So now that you're assigned at 350, even though it's at 335, you could convert it to a collar or a covered call position. Collar is important if you're worried it's still going to decline, and if you are, you wouldn't take this idea anyway. You could do that as well. Okay, so you take assignment on the position. Number three, you could take assignment on the position at 350. I don't know your account size, Alan. I don't want to know, but if you have the capital available, you could let yourself be assigned on the puts at 350, buy another 100, 200, or how many shares you want, or to even it out, at 335, 336 to average down. Now you might have a cost basis of around, let's say, 343 or 344, and you could convert those shares into a covered call or collar. So assign and then average down. Now, what most people will do in this case, of course, is they'll try to stay with this position, buy to close the put, and roll it down as we showed. You can use the position analysis view to look at the rollouts. There was only a few, but they were out to August where you could actually roll for a positive credit and be out of the money. It did show rolls where we were going to 345, 340, but to go to the 330 mark, roll down the put lower to 330, let's say, or to to stay out of the money, you're probably going out to September or October to roll for a credit. Because it's going to cost you, of course, $16 or so to buy to close this put. You'll have that $1,200 loss we saw if you got $450, and there you go from there. Okay, so but you could look at the rollouts on the position analysis. Are there any magic things that can be done to convert it to a broken wing butterfly? Try to convert it to a debit spread or a credit spread. Probably not with the loss that you already have. Okay, let's say we did collect $450 for this put. and now it's going to cost us roughly $16 to buy it back. So we saw a loss of about $1,250, $1,299 for one contract. Now let's think about it. If I converted this to a spread, if I bought an in-the-money put to try to get $1,250 back, immediately I have to go to the 362 or the 365, right? I need 10 or 12 points higher than this to buy a put to create a Bear Put Debit spread that would be at a profit. The problem is that even if I went that deep in the money, number one, it's going to be extremely expensive. Number two, in this case, it's not going to get us back to profitability. The stock has fallen too far below the put strike price to try to convert it to a vertical spread now to where we could still profit. Could you create potentially a butterfly, broken wing butterfly by doing a bear call spread on it now? I'm sorry, adding a bear call over here and adding a lower put, maybe to create an iron condor? Possibly, but if the stock continues to fall, you still risk larger losses, or large losses, not larger losses. Okay, so that's the situation we're in. Those are some of the options that you have. You can get put the stock and average down. You can get put the stock average down and do that also. Do the stock repair, something we would do. Okay, let me show you what that is real quick. So Alan here, and I see, Darrell, I see your questions. I see the other questions come in, everyone. We're going to get to them real quick. Let's just wrap up here with Alan for a little bit. One of our other signature tools, which you can access right up here at the top, is what we call the stock repair tool. Now what the stock repair tool does is you put in your symbol and you can put in your cost per share. Let's say I did get that $4 on Boeing. We sold the 350, so my cost basis would be 346. And let's say we just had 100 shares. And then you have more contracts. Let's just say we had 100 shares. What this tool does is it builds ratio repairs. There's credit and debit, so you want to focus more on the credits. But what you're essentially doing is looking at options to buy one and sell two. So we'd buy one 335 and sell two 340s for a credit, and it puts my break even back to 339.78. Now you wouldn't do this now with the naked put in play. Okay, you wouldn't do this ratio spread on the naked put. You'd only do this if you got assigned or if you're letting yourself get assigned in July. But let's say it was July, I did get assigned, this repair came up, which naturally it wouldn't because we'd already be past it, but what does it look like? Okay, so let's look at the repair details. If my cost basis was 346 on the stock, right now I could buy a 335 call for 725, sell two 340s for 435. So we get a credit of $1.45. Well, my cost basis was 346. I got $1.45 net credit, so my cost basis dropped down to 344.55. How is the break even only 339.78? Because remember, you bought a 335 call. If the stock's trading at 339.78, what happens? Well, you've got a loss of 622 on your stock, but your 335 call is worth about $5. You keep the 145 net credit, so there's the 622. You're now back to break even with the ratio call spread. And you can get a little bit higher premium here if the stock goes right up to 340 also. Okay, that's what it does. What does it look like graphically? Well, let's go back up, and instead of the repair details for that July one, let's look at analyze trade. Swing this on over here, folks. And there you go. So not a great return, but remember, you've lowered your break even from 344, 345, 346 down to 339. Now what if you shifted it? What if you bought another 100 shares if you had the funds to do it? You get put at 350. With the premium, your cost basis is 346. You buy another 100 shares at 335, so which is an 11-point difference. So now your cost basis for 200 shares is going to be lowered down by about $5 or so. So we're going to be at about 340.50 for a cost basis. Got put at 350, but the $4 premium averaged down, buying another 100 shares. Now I do the 2-to-1 ratio. I buy 2 and I sell 4. My break-even is now 337. Could make 1.8% if the stock recovers to 340. Okay, that's an idea. What doesn't this do? This doesn't help you down here. If the stock continues to fall, you will continue to have losses against it. Okay, so that's sort of the idea on the position. Alan, those are some of the just basic ideas. I rattled off 5 of them for you there that you could look at. What I want you to do this weekend, if you have the time, go to the webinars page, powerup.com/webinars.asp. That's our free page. You can access it at any time. Don't need to be logged in. Go to, I apologize, folks, Options Concepts. Check out this webinar, Manage Your Broken Positions. This walks through alternative methods for managing a stock position that has fallen in price, a covered call position that's moved against you, managing a sold put that is in the money or the stock has been put to you, and more. So you'll see some of those ideas in review as well as others that you might be able to take advantage of based on your expectation for the stock going forward. If you fear the stock is going to continue down, I hate to say it, you could try to convert it to a vertical spread to add some protection, but you may want to consider just taking the hit on this one rather than rolling it down, because if you roll it out to September, down to let's say the 325 or the 330 strike, or October, and Boeing continues down, you're just going to have to deal with that later. That's why no one likes to hear it, but it sometimes is an option based on your expectations. Close out the position, take the loss, follow your trading plan, and look to make that back with other trades. All right. This is an interesting one from John. John says, I have inherited 500 shares of PEP, PepsiCo, I believe. The original cost was $6.17 per share, and I have inherited that cost basis. It's now trading at $108.87. I want to protect the position with a married put, say the June 19 120. This will keep my list grow. Is this a viable option? Is it too deep in the money? Okay, what do I think? Okay, John. On first glance, I think that's too deep in the money based on your cost basis. Let's do it this way. First, let's go to the married put. And this is not the tool to use. I'm just curious to see what would happen. He said a July 19. Okay, so let's go to PEP. July 2019. I'm going to go to more results. It would have come up with all results. You said you did say, oh, you said June. It's June, not July. My apologies, John. There we go. How about that? Okay, so why did I do this? Let's lower that down a little bit. Let's go to more results. Perfect. Okay. Here's my thoughts on this. Why am I showing you this tool when this is not your cost basis and this is not the tool to use? If I was opening a married put on Pepsi right now, and I was considering going out to June, which I think is a good time frame for your cost basis and your strategy here. This shows me all of the risks. In general, when I'm a married put position, I'm going to look for 1 or 2 strikes in the money with a risk probably between 3 to 8%. So you can see right away where my eyes are gravitating towards. It's these 3 here. The 105, the 110, and the 115. 1 or 2 strikes in the money, 108.87 as you mentioned. This one's actually out of the money. So these 2 here are 1 or 2 in. Why am I highlighting this? Well, it's because this is the range I typically look for. And I like only being 1 or 2 strikes in the money, because if I buy this 110 put now, sure, it's going to cost me a little bit. But because the stock's at 108, I might be able to do an income method right now. Do an income method number 6, a bear call spread by selling maybe the 112 and buying the 115 for a near-term expiration. Still leaves the upside open for a run. Maybe just sell the 115 call. But if I buy the 120 put, you have lower risk, absolutely. You have a deeper in-the-money put, but it might be harder to do adjustments on that position because you're so deep in the money. All right, so my eyes are focusing right here. It's not about the cost at 14.43. If I was opening this position right now, John, I'd be in one of these 3, and I consider it to be the 3 bears. Even though this puts out of the money right now, the risk is 8.6%. a little bit higher than what I usually like to see. The 115, great risk if I open this position right now of only 4.2%. It's only a strike and a half in the money, really, okay? And that's not too bad. But usually when I'm looking at these numbers, when I look for the range that I want to see that's worked well for me in the past 10 years I've been trading radioactive positions, I consider it the three bears. So I see this one. What is the risk? What are the cons of going to the 115 or the 120? It's a little bit deeper in the money. You need a little bit more movement on the position before it makes sense to start doing the income methods, even with your lower cost basis. Okay, because you don't want to get trapped. If I buy the 120 and sell a 112 call, and the stock goes up to 118, I'm actually losing $6. I sold the call at too low of a strike price and too soon. The 115 is not bad, but right here in the middle, not too hot, not too cold, just about right in the middle. 6% risk, really decent. 110, half a strike in the money. Would be able to do an income method right away on this position as well. There's nothing wrong with the 115, but I do feel the 120 might be too deep in the money. Because if I was opening this position today, my focus would be on the 110, 115. Now, the tool you've used, I'm pretty sure that you were talking about, is the insurance tool. All right, so this allows you to put in your stock, and you can put in your cost basis. I'm just going to put in a different number. It's okay. And we'll just go to your June value. And I'm not going to sell a call. Okay, we're going to go to your June expiration. I'm not going to sell a call. But this tool automatically calculates for me, if I had a cost base of 60.17, I've got an 81% yield on the position. And look at the top two that come up, the 115 and the 110. They lock in the most amount of profit. Now, this might be skewed because of the bid-ask spread on this position, but the 120 looks like it's costing you a little bit more, 0.5%, 0.2%. That's okay as far as that goes. Still the highest locked-in profit, one of the highest locked-in profits monetarily. But look, you can still lock in 61.6% of your profit here at the 115. This tool is telling us that the 115 might be the best buy right now at midpoint if you can get it for the June series. I like the 110 personally. That's the put I would use if I was opening a Mary put on PEP today based on my stock selection. That being said, it's based on your expectations and what your plan is going forward. If you're not interested in maybe doing other adjustments at this time because you don't want to maybe cap the upside gain by selling a call against this married put structure where you have this giant locked-in gain, I understand that and appreciate it. And in line with that as well, there's nothing wrong with the 120. You just asked my opinion. My opinion would be going to the 115 to 110. If I was opening this position brand new today based on a friend's suggestion or getting into it at this point, I would go ahead. I'm sorry, folks. Hold on 1 second. I got to fix something here. I saw some comments that came through on this discussion, and then my questions flipped on me. Okay, good. It went into the wrong order. And Rhajiv did comment going back to the BA position as well. Alan, Rajiv's comments is you still have a lot of time. BA can recover. There's absolutely nothing wrong with leaving it open right now either. Just remember that you could be assigned early. Okay. Okay, so let's see here. Okay, hold on 1 second, folks. Just bear with me 1 second. There's 17 extra comments that came in. I want to take a look. Okay. Rhajiv, going back to what we were talking about with Boeing, I'm sorry I missed some of the Boeing comments. Rhajiv had mentioned rather than a ratio, would a collar help here? A collar would help the further downside, but it wouldn't give you the benefit of the ratio where you have the bull call debit and the covered call that increases as it moves up. Can you add a put after doing the stock repair, the ratio spread to protect the downside? Absolutely, but remember now you're changing the dynamic of the position. Okay? But doing the ratio spread, the stock repair, and adding an out of the money put to it to stop the downside if it keeps falling is a good idea. But remember, we only got $1.45 credit for the income method, the ratio call spread of the stock repair. I apologize. And so in that case, if I pay more than $2 for that put, I've taken away the advantage of the credit in the initial one. I'm going to go back to that in just a moment here. Let's see here. No, it's not in there. Let's just do this real quick. I'm going back to Boeing very quickly. And let me build that repair we saw for July once more, just so I can answer Rhajiv's question. Mark, I see your comment too. I'll get to that in one second. I know we're bouncing around. I'm not done with the conversation we just had. 335, 340. Oh, shoot. We bought stock. We were going to buy 100 at 346. There we go. Buy 1, 345, sell 2, 340s. I think we were actually on the 13th, but that's okay. All right, so there we go. There's the repair with the cost basis. Now, net credit for this transaction, this one's a different one. We went out to July 20th here. So we've got about $300 or so, almost $400 worth of credit. So I go to July 20th now, and I've got to find a put that's less than that. Okay, so let's go to 320. So we're going to buy one. We only have to buy one put for the 100 shares at this point with the stock repair in place to protect the downside. This is a ratio spread with a collar. What happens? I take out the profit. Okay, it's a wash. The max profit is a wash at this point because of the cost. So now I'd have to go back in and get a different cost basis for this trade. Okay, I'd have to find something else and in order to make this work right on my trade. Okay, sorry about that. Something just hiccuped there. Okay, now okay, Mark's question, going back to our other window here, going back to the Pepsi position. But related to the Pepsi position, that's what I would do. I would take a look at the stock repair tool, put in your cost basis, see which one happens. But again, now, let me go to the 115 in this case for Pepsi. But let me do it with the current stock price. I think this is more along the lines for Mark's question. Let's say I entered it right now at 108.87, bought that June 115 put. This is the 115 now. Oh, you wanted the 110. Let's change it. I'm sorry, folks. Let's go back to June. Oh, let's go to the 110 put. And so Mark had commented that is the rationale for the covered bear call spread is that Pepsi goes wildly up. The debit call can capture the gain after you allow the stock to be called away. Mark, you're confusing two things, I think. Okay. What I was showing was the ratio spread in radioactive terms, what we call income method number 5. When you say covered bear call spread or bear call spread, that's income method number 6. It leaves the upside open. Okay? How would I do that income method number 6? Well, now that I've got my, let me get to the graph. There's my married put with only that 6% loss, nice even numbers. But since I'm close to the current put strike price, I may consider, and it's not going to look good, I can tell you that right now, but I may consider doing the bear call spread. And let's go right at the money. I'm going to sell the 110 for $1.40, and let's buy the 114. Bear call spread, 110 and 114. So we're going to get a credit of about $1 on a 4-point spread, which means we could lose 4 points if the stock moves up. But since I own the stock, this counters that loss. But this is a no-no. You never do it this way. I would never do it this way at all. Okay? I don't want the event of the bear call spread to put me back into a loss where I need it to go back up to 115.81 before that infinite profit starts kicking in. Mark, this is income method number 6. This is a no-no. You would never do this. It's not worth it. Wait. And that's why I said because the put was so far out, we only paid $8.13 for it, which is a fantastic price for that much time. But even though we got $1 premium against that, because of the cost basis of the stock, extra cost of the put, if I got assigned at 110, we don't get a lot of buck because we're well below our cost basis of 115.89. And here, I don't like this at all. I don't want to go back into the negative. This is a bear call spread. The upside is infinite. Okay, so what happens if the stock goes up to 130? Well, I have to close the 110 call. Let's say I buy to close this for $20 because the stock's at 130, but I sell to close the 14 at $16. So I take that 4-point loss just as you would on the bear call spread. But we took a $1.10 credit, roughly. So my loss is only $2.90. And the stock is up 22 points, and my upside is not blocked because the obligation of the short call is covered by the long. That's the bear call. That's income method number 6. It leaves the upside open. Income method number 5, where you mentioned that the debit comes into play. Okay, let's take a different view. Let's say much better position, much better risk graph very quickly here before we go back to our conversation. Sorry, I bounced around there for a minute. Let's just take Ollie's Bargain Brands. Cost basis of 69, and I believe I own the October 75 put for a cost of $4 because I bought it at 67 or so, had the 70 put, rolled it up to the 75 when the stock moved up. Okay, it's not quite bulletproof. Oh, this one is a bulletproof one. But now the stock's at 72.50 and I'm holding the 75 put. What I'd want to do for a proper income method number 6 is sell the 75 and buy the 80. This one's easier because it only has 5-point strike differences. Now, that's what I want. I want the bump's going to happen, and it's because I'm giving up on the short call. I have an obligation to deliver stock, so as it's moving up, I'm not getting it. But once it crosses here, we're back to positive delta. Sorry, we're back to positive delta, Paul, in this case. See? So I sold the call here. It doesn't go back into the negative as we've seen with other positions. Okay, we don't get that drop down in the value where it goes negative again, and that's not what you want. But that's the 6. That is the income method number 6 position. Okay? Bear call spread, sold the 75, bought the 80, infinite upside if it continues above the long call, but I never want to do an income method number 6 where this drops back into the negative range. That's not how you do it. But income method number 5 is the other one. Okay, now, so we covered the Pepsi position there. We talked about that. We talked about the numbers we want to look for and the tools you'd want to look for in this case to do it. Nothing wrong with the 120, nothing wrong with the 125 even. But in general, I treat it almost if I was opening a new married put today, and I'd be looking at the 110 or the 115 personally. I could do an income method number 6 to leave the upside open or more. PM sent in a question early. Oh. Okay, sorry about that. PM sent a question, what about just buying a call or put? Can you give us some thoughts on how you would do that? Well, in general, it depends on your outlook for the position. Okay, we have in the search, you go to long call or long put. You can go to the search. We have default searches, PM, that are created for you to use as a stepping stone to create your own personal search. Okay, sorry, that's something I was playing with earlier today. Ignore that. There we go. So here's some opportunities for the Bollinger Band default. When you're buying a call or put, one thing I'll suggest is don't fall into the weekly trap. If you don't know what you're doing, if you're new and you're just starting out, or if you've been trading different strategies for a while, but now you're considering going to calls and puts, I would not recommend buying weekly calls. 1 week out, 2 weeks out, maybe even 3 weeks out. Okay? That is very speculative, and you have to be right on the movement of the position, and you have to be quick and watch it more frequently. Right? If you're just starting out buying calls, you're probably going to want to go at least 60, 70 days out in time to allow the position more time to move in your direction and result in a profit. Now, that being said, of course, Rhajiv, he's got some other questions that have come in too, and Sam's usually with us, and he sort of legs in and out of straddles and strangle positions 10 days out, 14 days out, maybe sometimes even 5 days out, tracking one position or another. Whether it's SPY or whether it's something along those lines. And in that case, he does that, but he's been trading for a long time. So is there a best call to buy? Well, it depends on what your outlook is. Okay? If you pick a stock and 25 days from now the stock's up 10%, most any long call you buy that's beyond that will give you a profit. Okay? In that situation. However, if it only moves up 3% or 4%, the at-the-money or slightly in-the-money calls might have been profitable. The out-of-the-money ones weren't, unless you had a profit before expiration you sold to close it. So again, I'm going to keep it simple. I'm going to stay with, let's just stay with PEP. We saw it at 108. Let's say that I have an expectation. This is called the long option finder. I have an expectation that Pepsi might be trading at 118 in the next 30 days, end of July. And I'm going to put maybe, those were not really expensive, so I'm going to put in $1,500 into buying calls. Okay? And that brief moment, what this tool did is it went out and it looked at every available option for Pepsi. And it showed by order of return which one would give us the best return if my stock did hit 118. Now, why am I showing you this? Because if you're planning on buying a call or buying a put on a particular stock, it's because you have a projection of where the stock might be trading. This tool helps you better pinpoint which strike would give you the best bang for the buck if the stock did hit your target price on your target date. And so in this case, we see the August 115 call at a price of 49 cents. With my $1,500, I could buy 30 contracts. And if the stock did hit 118, they'd be worth 305. I'd have a 500% return on the position. Okay? But the search tool is designed to help you find positions, and we have defaults that you can use as a criteria. But again, if you're just starting out, don't get lured into this idea of buying cheap options that are 1 week out, that are 4 days out, 7 days out, or 10 days out. Because you have to watch it to get the profit, and you'll be watching your screen consistently. And you could say, oh, well, these options that are a week out are only 40 cents, and the stock moves up, and you say, oh, look, I've got an 80% return. So you close it. Well, you closed it for 65, 70 cents. Okay? You got an 80% return or 65% return. That's fantastic. But how many contracts did you buy? And were you expecting more for the position? Because if you hold it, and after the next 3 or 4 days you don't have that return, you run the risk of losing that 20 or 30 cents of time value you paid, and you have 100% loss. So in rapid fire. So buying options, speculating on movements of positions, if you're just starting out, make sure you go further out in time. Don't try to play the weekly game if you're just starting out. Once you get more familiar with how the calls react with the market, then you might try it shorter term. As we did earlier before PM, I'm going to suggest you go to the webinars page, powerop.com.webinars.asp. Click on Option Strategies. Down here in the list, let's find it, selection criteria for long options, buying calls and buying puts, and managing your long option positions. Check those two out this weekend. Yes, they're 3 years old roughly, but it's the same material I would present today, just with different potential images. But it wouldn't be anything different along those lines, okay? All right, let's see here. Bill had a previous comment that I missed related to SPY and talking about the Bear Put Debit. He said, isn't it further complicated because SPY is an ETF? Once it gets converted to a cash value, there can be some slippage as the various components move. And that's why you've stayed away from ETFs. Now, that's true. The settlement date on Friday, their settlement price, the closing price you see on Friday might not be the settlement price, which is typically why standard expirations, options, aren't really closed out until Saturday. But the weeklies are always closed out Friday evening. There may be some slippage. But that would be if it was right at the strike price, Bill. Meaning, in our SPY example, we're talking about a 277, 279 bear put spread. If it's anywhere below 276.40, I'm pretty much 100% guaranteed to get the full return back. There's not going to be any slippage above 60 to 70 cents. Hardly, unless there was a really quick movement at the end of the day in one direction or the other. In this case, it'd be up. Secondary to that, if it's right around on that Friday expiration for that Bear Put Debit spread, if it's around that price, 277, 276, something along those lines, I could still probably get almost 90 to 95% return and not have to worry about the slippage. I would just go ahead and close it out. Sell to close the one, buy to close the other, get close to that $2 premium. I would sell 90% of the max return I would expect on the position. But again, in that case, I'd still be close to it, okay? All right, so I believe Darrell was first. This got out of order on me, so let me make sure I've got, Darrell, I'll say Darrell. Darrell, I'm sorry, Darrell. Darrell was assigned 1,300 shares of RCL at the 105 strike. Okay, RCL, 105 strike. Okay, RCL. I don't have to put the thing there, but we'll just put in Royal Caribbean. Okay, 1,300. And cost base of 105, but let's say you got some premium. Let's call it 103.50 is your cost base. Maybe it's 104, all right? Oh, sorry. Now, sorry, you immediately sold 13 calls for July 6th at the 106 strike. Good. Okay, a little bit out of the money here, but I'll just use these current prices. Okay, so you got assigned. You sold the calls against it to be a further hedge on the position. All right. 7/6 expiration. I took the profit. Okay. Okay, so here's the question then. Here's the real question. It took the profit for today. But all this is to explain the evolution of my question, which is why should I sell at the money or one strike out? I would like to keep selling to regain my 4K loss on the spread, and if it seems to me I won't be able to do that if the stock is taken. Well, that's part of the problem, okay? You had it at 105, and maybe you meant your total cost basis was 105 when you got assigned. I assume that you got assigned at the 105 strike and you got some premiums. Your cost base is 103.50. So this, you want to be out of the money even though it's lower premium. I'm not understanding the question really, but you want to be out of the money because if I sold anything below it, I'm probably risking assignment right away, okay? And that runs into a problem. So when you're trying to repair a position like this, and you could use the stock repair too, Darrell, that we looked at a moment ago if you're trying to get back to break even faster, if you're not at break even now. This position I think is. And this is an out of the money call to generate a dividend-like income or maybe even higher for a 7-day, 8-day trade. Okay? But I want to be out of the money because if the stock stays in this range or just moves up to 104 or 105, that 106 call expires worthless. I still have the 1,300 shares. And now I can sell another out of the money call and continue to lower the cost basis. Okay? Now, you said you took the profit on the option. It seems I should take the money and run, but will I sell 13 strike on the 7/6 on Monday? Wait. Yeah, this is practical. I'm sorry. You kind of rephrased the question here in a second question. So, Darrell, yes, in my mind, this is practical. This is what you want to do. If you want to stay in the stock and keep generating income, you're going to have to go higher strike price. You don't want to be below it, even though they offer a better premium. But what you may want to consider is if you go further out, instead of just going 7 days out, if you went further out to July 20th and went to the 110 call, you could get the higher premium. Now, it's not a higher premium per week, but you could get 52 cents per contract on the 13 strikes, and you're not at 106, you're at 110. So you might want to consider going further out to get more premium, although if it's an average week, you could still generate weekly by weekly income selling against it if your plan is to hold on to that. Follow-up question. If anyone knows, you can send the email. Darrell says, does anyone know where I can get a big poster with all the risk graph configurations shown to hang up in my office as a reminder of which one I am trading? Well, I'll try to put one together for you, but I don't know if I'll get it in poster form. But we'll try to put one together for you, something simple and easy with the common strategies there, Darrell. So see what we can get for you on that. All right. Now, covered. That was, uh-oh. Okay. All right. So we answered Mark. We answered Bill. Now we're on Rhajiv. All right. So Rhajiv says, on Pepsi, bull call debit 100 to 105. Now I move to a bear call 110 to 112. Okay. So let's see. Originally with Pepsi, And I didn't even look at the chart yet, okay? I was just analyzing the other position there and what I would do. Okay, well, you know my second answer, Rhajiv, right off the top of my head. But first, let's look at this position. 100 to 105 bull call, right? That's what you had. You had a 100 to 105 bull call debit. What I don't know about this is if you rolled the position because you had a profit or something else happened. But see, now you said you've closed it. So this would have been, this would have been a good position, 9.2% return. Might have won a little bit higher, actually, but that's okay. And it was looking successful, but I think you maybe took some profit off the table, and now you're holding a 110, 112 bear call with a stock at 108. I did July 20th? I did. Good. All right. So, I don't know, maybe your premiums are close to this. That looks pretty good as far as the return goes. But your question is, should I move the position or adjust further? Earnings are also before July. First off, you know me, Rhajiv. I would never suggest being in a debit spread, credit spread, condor, or any type of thing that has this risk-reward profile when you've got earnings coming up before expiration. There's too much risk that it could go up to 116 and 118 and you're giving it back. Now this is a lower risk, almost just a 2-to-1 risk-reward ratio on the strategy. I see that. But again, I would never do a spread position, especially something this close. But I would never do a spread position. I wouldn't do a bear call, bull put credit spread, bear put debit, bull call debit with earnings happening between now and expiration. I'd do it before the earnings. I'd do it after the earnings was released, but I'd never do it through the earnings. Okay? It's too much risk of seeing something that looks like it was profitable plus the profit you might have taken on the other going into a full loss or going into a loss just because you rode it through. My general rule, this time frame actually is the 1% rule. I'm going to look to adjust, meaning that when the stock reaches within 1% of my short call or my short put in a bull put credit spread or bear call credit spread, that's what I look to adjust the position. Okay? That's what I'm looking to do there, Rhajiv. All right, so my apologies. One moment. There we go. Mark, I'm sorry. Oh, there we go. Yeah, okay. Okay, there you go. Mark mentions that there's a website. It's called optionsplaybook.com, Darrell. And what he's suggesting is that you can go ahead and just use get a chart, paper, and scissors. The options playbook, you can print it out, and it just has the basic profit and loss chart. We show the basic profit and loss chart too when you go into all the strategies as well. In that. So that's just another idea for that. It's optionsplaybook.com. It just goes through some of the education, the different strategies, and he's saying, I think now you can view it online or print it out, and you can just cut out the printouts with that. But I'll see if we can come up with something a little bit different in poster form. Okay? And Rhajiv, follow-up. You've got a September bull call debit? Yep, bull call debit on Johnson & Johnson, in this case. September, 125, 135. Okay. Yeah, this one is just, you'd said, so this is an out-of-the-money bull call. We had talked about that a little while ago. If I entered it now, it's got a 1-to-1, no, I'm sorry. My apologies, folks. It's about a 3-to-1 profit, 3-to-1 reward to risk instead of the opposite direction. But in this case, you says you've got this with a 250 debit. All right, so it's a little bit higher than what we're showing here, but not too much off. I'll be able to wait for August on this for movement. Sure, wait for this one because you've still got time on your side. I would say if you get within 40 days, 35 days to expiration and it's not getting near to where you want, we might consider trying to do something else to manage it. But right now you've got it far out in time. Your goal was to have it somewhere in this range, probably in the 134 to 138 range for the profit. So you're just going to wait on that. Okay. Fernando, this is a tough question. I have my answers. Oh, and John, you're welcome. And Rhajiv, you're welcome. John says thanks for the information. Okay. All right. And Darrell says thank you as well. He'll take a look at that. John, you're welcome for the analysis on the PEP position. That's what we do. All right. Fernando's talking about radioactive positions. The radioactive trade, the married put position, and one of the income methods, the one I use most frequently to be conservative. It's not the best one, but it's the safest one. It cancels the most risk when done correctly, but it does add to the cost basis, which takes a little bit away from your upside profit. We're talking about income method number 4. Now, let's go back to Ollie. Let's say that on Ollie, I had a cost basis of, now that's not a good position. Let me go back one second. Let me go home to the home page for a second here. I'm trying to think. Oh, perfect. I'm going to use SNE. I'm in a completely different structure, but I'm looking for a stock that I know has moved the way I wanted to, Fernando, in the past couple of weeks. So let's go to the chain for SNE. Currently at 51.26, was up to almost 51.67 the other day, but it's been as low as 48.50 in the past couple of weeks. So we're going to cherry pick. I'm going to go back to June 14th before standard June expiration. And Sony was trading at 49.13. Okay, remember that, 49.13. And I'm going to go out to October, 127 days. Usually I go further. Oh, we only have 50. That'll be fine. I'm going to buy the 50 strike put for 285. Okay. All right. So first, let me put this back into the portfolio. These are my prices. So back on June 14th, might have entered a married put position on SNE. Just put in 100 shares, 614. Whoops, my apologies, folks. And bought the October. I was going to buy the 51, but that's okay. This will work just as well, Fernando. And we bought this for $285. Very good. And also on 614. Now the stock is up to 51. It's above our put strike price. Okay, 51.26. We've gained 213 on the stock. Only lost 63 cents on the put. That's about right for the delta. And we still got a gain of about 2.9% on the position. Let's go to the profit and loss chart first, and we'll go back to the chain in just a second. Yeah, it's a pretty low risk position. Two things I want to do, Fernando. Number one, oh, sorry. I'm going to go to 1 month chart. Why? Because June 26, where were we trading? We were trading right at 50. We went above it over here on the 22nd, but right at 50. Look at that. Okay. Right at $50, we have the 50 put. And then yesterday, or even we'll use today. We'll use 626 and today, 629. All right. So where am I going with all this? Let's go back in time. 2 days. We know our position. We have a 3.8% risk. The stock is above our put. We got the stock at 49.13, and then we saw some movement upwards, a little hiccup, but then by 626, we were trading right at $50. Okay, so why is this important? Because we want to compare the two potentials. My answer is that it's actually best to wait, Fernando, for the stock to go a little bit above the put strike price, maybe between the two strike prices. So if I have a 50 and I'm considering rolling to the 52.5, I think the better deal is when the stock's trading at 51, a little bit above my long put, but not quite to the next put strike. rather than when the stock is trading right at the put strike price you originally purchased and your delta is 5. That is when the time value of the option that you bought is going to swell. That's absolutely true. When you bought it in the money, you had a lower time value. As that option went from being in the money to at the money, the time value swelled, which is why income method number 4 works so well. But, oh, and that's important too. I got to go back for a second. We paid $285 for the put, but the time value of the put was $198. The risk was $198 when we opened this position on June 14th. I should have mentioned that. That's our time value. On June 26th, stock right at 50. Can't peg that any better, can we? Go to October. The 50 put is at 260 midpoint. So what happened? The time value swelled, didn't it? It went from 198 to 260 because it's all time value. We're right at 50. The 52.50, we're at 395 at midpoint. Okay, 52.50 at 395. Now, let's go back to the custom spread. On June 26th, stock trading right at 50. I sell my 50 put for 260. Right, that was the midpoint there, was 260. And I buy the 52.5 higher strike put at 395. And this is all time value. And the 395, of course, at the time, 250 of this was time premium. 250 was intrinsic, Fernando. 145 was time premium. We go from a risk of 3.8 down to 1.6, or $83. Not too shabby. In one move, we've taken the risk from 198 down to 83 cents. Taking the risk down from, what was it, 2.8 to 1.6. Okay, now, today, stock's at 51.26. It's almost right between my two strike prices of 50.50. I'm sorry, it was a 3.8. Okay, so we really took that risk down. That's what I wanted to see. We took it down by about 2/3. Fantastic. But now the stock's moved up further, Fernando. I'm going to get less for this October. I'm only going to get maybe 220, 223, but I'm also paying less for the 52.5. I'm between the strike prices. Is it better, worse, or even? Let's take a look. Getting a midpoint, it's a little bit better, isn't it? Okay, we're down to $60 instead of 83 at risk, 1.1%. My income method number 4 is I've been doing them when it's between the strike prices because I think I'm getting a better price. I'm waiting for it to maybe go up to 51 or 50.95 and then rolling to the 52.50. Or if I had the 110 put, I'd wait for the stock to go to 111 or 112 and then maybe roll up to the 115. Not when it's right at 110. I want to give it a little bit of breath there. Now, sure, I'm not getting as much back, but I'm also paying less, and I've typically seen that that gives me a little bit better bang for the buck. So wait for it to go a little bit above your initial put strike price. Wait for it to go a little bit out of the money. Doesn't have to be halfway between the strike prices, but I'd like to see a little bit more. We get a little bit more advantage here. We take the risk down to 1.1, another 0.5% from had we done it if the stock was just trading right at 50 at the time. Even though that's when the October 50 had the highest time premium, it still retained a large portion of that time premium, and the 52.50 dropped almost 60 cents in value. Yeah, so remember we sold this for 260. We lost. What happened? Where did the benefit come from? We only gave up about 40 cents of value here, but we paid about 60 cents less here. So that's a 20-cent win. 60 instead of 83. Not a lot in this case, but look at the percentage. Doing it when it was right at the strike price, just even 2 days ago, would have been a risk of 1.6%. Fantastic move. We took it from 3.8 to 1.6 in 12 days without adding too much cost into the position to do it. More than cut it in half. Let it cut it down by 2/3. But waited a little bit extra for it to go a little bit out of the money, a little bit higher to be almost right between the two strike prices. We take another 0.5% off the risk. That's what I've been doing with my income method number 4 is I'm waiting for it to move above the put strike price, not necessarily halfway between the two, but close to that almost, if possible. And sometimes, of course, you might panic and say, if it only goes to 51, I might as well do it now. That would be fine. If it only goes to 50.85, might as well do it now. That's fine too. Remember the key rule, though, main rule for me, Fernando, when doing income method number 4, make sure the debit that you're paying anytime you're doing the adjustment. Here we're looking at a debit of 110, well, let's call it 115, or something, to gain 250. Okay, what am I pointing at here? The debit I pay to do this roll divided by the strike difference, I want this ratio to be less than 0.6. Okay, or I want the debit to gain and strike ratio to be less than 60%. And we're pretty close to that there. 115 to 250, we're under 50%. Right? It'd be, if the debit was 140, I might not do it. If the debit was 160, I'm not doing it. But if the debit's anywhere below 125, maybe even below 130 or 135, 60%, I'm probably doing it. Your other one was within that range too, remember. Your debit, we would have paid 260. I'm sorry, we would have sold the 50 put for 260 on the 26th, bought the 52.5 at 395. You've got a debit of 135. That's still under. It's right at that 60% range that I look for. Let's do the math real quick here. Can't do it on the top of my head. But so, what am I talking about here? If I paid 135 debit into the position to gain 250 in strikes, 0.54, 54% ratio, below 60. That's what I want. If it's at 65, if it's right at 60, I might not do it because I don't feel I'm getting as much benefit at the time for doing that income method number 4. The debit's too much. I'm going to wait till it gets lower. Okay, so those are my thoughts on the income method number 4. All right. Well, ladies and gentlemen, we are at 5:51 p.m. Eastern Time. It does look like we have covered every topic that came in, both those via email and those live. However, if I missed a question, I do apologize. We added our comments in as well. I just want to remind everyone, of course, that if you... Let me reverse it. I just want to remind everyone, of course, that today's material, these are my thoughts on your questions, designed for educational purposes, increasing investment performance and options knowledge. Of course, any stocks or options discussed today should not be taken as direct trading suggestions. Not making a suggestion to buy Pepsi. If you do buy Pepsi, I would suggest buying it as a married put near the strike prices I selected for safety. I'm not saying to do a Bear Put Debit spread on SPY or a Bear Call Credit spread on SPY. I was using that as a quick example, comparing the Bear Put Debit to the Bear Call Credit Parity. Any stocks discussed today should not be taken. Options involve risk. We've seen that. We saw examples of that today. It may not be suitable. Reminder, markets are closed on Wednesday, 4th of July, and we close early on Tuesday, 1 p.m. for July 3rd as well, okay? As well. I apologize. Yeah, so we're going to close early on Tuesday, be done at 1:15, and we're closed on Wednesday. So might get some extra time premium decay for us when the markets are closed, but hopefully they don't open on Thursday with a gap one direction or the other as well. Remember, if you haven't taken a look at Power Options, just go to www.powerop.com, put in your first name, last name, and email address, and you'll be able to start your 14-day free trial. No credit card required. Subscription levels after that start at $40 per month. The most popular service is the delayed service at $60 per month, but we do offer a real-time and the historical service, which includes 20 minutes delayed and access to the historical tools, which we kind of showed screenshots of. We ran that search for the weekly naked puts on Monday, and to see how they performed, to show our 87% probability this week, looking at those positions in our probability discussion we had for David at the beginning of the webinar as well. In addition to that, we referenced the webinars twice today. Remember, you can go to that at any time under the option strategies, that discussion on long calls and managing long calls. More importantly, I think for everyone, is in the options concepts section, the webinar on managing a broken position, talking about different ways to fix a stock if you're just a stock trader and it's moved against you using options, or you have a covered call that's moved against you, or naked put in our case, for today's discussion that got put to us or might get put to us at the higher strike price. And you can always check us out on YouTube as well. If you do think of any questions later on, remember, send me an email at any time to either support@powerop.com or support@radioactivetrading.com. You can also call us during market hours at 302-992-7971. And trial members and subscribers can schedule a coaching session. Mark asks, is there a one-page sheet on the various income methods for subscribers? If you're a Fusion subscriber at Radioactive Trading or you own the blueprints, if you log on to the Radioactive Trading site, let's see, switch screens again, my apologies here. Sorry, there we go. So let's see here. All right, so if we go to, oh shoot, I thought I was already signed in. Okay, my apologies. Well, if we go to radioactivetrading.com, a blueprint owner or a Fusion subscriber, there we go. All right, so we log in here. And Fusion subscribers, you have access to the lessons, the trades where you can track Greg's earnings and my married put positions and so on and so forth. If you're a Fusion subscriber, click here for members only webinars and white papers. And there's an income method number, the income method cheat sheet over here on the right for the articles. It's not a one page, it's a couple of pages, but that's the income method cheat sheet. Same is available for blueprint owners. So if you log on, if you're a blueprint owner and you log on to your free registration account, just click on the blueprint owner only webinars. You've got the 12 income methods in review presentation. Oh, I'm in the wrong spot, sorry. Blueprint owner, click on latest blueprint and revisions. But yeah, you can go through the blueprint owner only webinars as well. And here's the income methods summary. Okay, so you can access click on that and get the income methods summary as well. So whether you're a blueprint owner, you can access it there. Fusion subscribers, go to the members only webinars and white papers, and over here on the right, you've got the income method, oops, sorry about that, the income method cheat sheet that you can access. Okay, that's how you can get to those. Of course, you always have all the other webinars there too for members only. All right, so that's for you, Mark. That answers your question. You can just log on to radioactivetrading.com with your credentials as a blueprint owner or Fusion subscriber, and you can access them there in those fields. All right, fantastic. Well, ladies and gentlemen, thank you once again for joining us for our Friday presentation. Thank you for your questions. Greatly appreciate them. Good discussion today, as always. I hope you all have a fantastic weekend. And if I don't see you online or talk to you or have a discussion with you via email before then, have a happy 4th of July. Take care, everyone. Enjoy your weekend. We'll see you soon. Good night.